US stocks surged again overnight to fresh record highs on confidence about a soft landing in the United States. That's in contrast with stocks in China, which slumped the most in 18 months to new 20-year lows on worries about deflation and capital outflows. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ's chief economist for Greater China, Raymond Yeung, takes a closer look at the growing numbers of unemployed migrant workers in China's cities and maps out what that means for wage deflation in the world's second largest economy.
China lost 2 million people in terms of the total populations. But at the same time, we also know that the labor market is under very strong cyclical downturn, which means that unemployment is actually very high.
But first, in 5 and 5 with ANZ, US stocks surged again overnight to fresh record highs on growing confidence about that soft landing in the United States. But it was the exact opposite in China, where stocks slumped another 2.4%, 20-year lows, on worries about deflation and capital leaving the country. There are reports this morning that China's authorities are orchestrating intervention to support the yuan and buy local stocks. However, the US dollar was steady overnight and US Treasury yields nudged only a few basis points lower. That meant the Aussie and Kiwi dollars were also broadly unchanged at 65.88 US cents for the Aussie and 61.03 US cents for the Kiwi. That's at 5 a.m. Sydney-Melbourne time. Number 2. One feature in economic and financial markets news overnight was a sharper than expected fall in Taiwan export orders in December, 16% down. Here's ANZ economist Bansi Madhavani talking this morning from London.
What we think is playing out is continued weak demand and also destocking that's hampering orders demand. There seems to be a wait and watch sentiment towards equipment investments specifically. Just in terms of going forward, the Ministry of Economic Affairs also cautioned that the first quarter of this year could be an off-season for electronics, but we expect orders momentum to pick up after that on the back of demand for artificial intelligence, high-performance computing, and in general leading semiconductor chips.
Number 3, China's banks left their 1-year and 5-year lending rates on hold yesterday. That was expected, but it's also in the face of calls from overseas for stimulus and worries there about deflation. Here's ANZ chief economist for Greater China, Raymond Yeung, on why China's state-owned banks aren't cutting rates. They don't want to cut their profit margins.
They really want to have some breathing space instead of cutting the rate immediately to echo the macroeconomic concern. By the policymaker, they do need to look at the banking profitability and also the financial stability in reality. So I think that's a reason we can justify why China has not cut the interest rate despite the strong deflationary pressure.
Number 4, in Australia, consumers are still being very careful with their spending after a year of rising interest rates and cost of living pressures. ANZ's observed retail spending figures for December showed in particular that spending on fashion was weak over the various sales events leading up to and after Christmas, and that includes Black Friday, Cyber Monday and Boxing Day. Here's ANZ Australia economist Maddie Dunk.
Fashion retailing is very soft right now. We're seeing that it's down, around 10% during that Black Friday period and down 16% year on year over the Boxing Day sale that we had. But then you compare that to electronics spending and department store spending, which have been a lot more robust and have actually performed reasonably well over these key trading days.
Number 5, the big decision to watch in Asian trade today is the Bank of Japan's policy decision, which is widely expected to be no change in its main policy rate, which is still negative. ANZ's head of FX research, Marjabeen Zaman, doesn't see a change in that policy rate until maybe April, with the main focus before then on the Shinto national wage negotiations in March.
Last year, we saw, I think, about 3.8% of wage increases across the board on Shinto. What will be important to see how they continue, if they continue to rise from there, and what that means for the real wages in Japan. Based on most recent data, real wages are still deeply negative for Japan, and as a result, don't expect the Bank of Japan to, continue to hike rates after they make the initial shift in April.
Marjabeen Zaman there. Now, in part one of our bonus deep dive interview on the problems brewing inside China's workforce, ANZ's chief economist for Greater China, Raymond Yeung, focuses on the number of unemployed rural workers now stuck in China's cities without jobs.
We all know the demographic challenge facing China. Aging population and the shrinking population too. Last year, China lost 2 million people in terms of the total populations. But at the same time, we also know that the labor market is under very strong cyclical downturn, which means that unemployment is actually very high. Even though the December urban survey jobless rate was reported as 5.1%, doesn't seem to be very high, and it's just 0.1 percentage point higher than the previous month. The reality is that many rural workers may not be captured by these official statistics. So on one hand, in the longer term, we have been concerned about the shrinking population and the workforce. At the same time, cyclically, the workforce is under a strong, surplus labor situation. So how China is going to manage both would be a very challenging policy question to Beijing.
Could you tell us about the comparison between China's rural and urban economies with, in some ways, some of the similarities between the United States and Mexico?
I highlight in the research notes that when we look at the urban-rural labor market and the workforce mobility, in developing economics, that I've learned, 2 or 3 decades ago, that at that time people used to look at the Mexican labor force and how that can augment the U.S. economy. When China opened up, that's also a typical, comparison for the rural worker working in the urban area. In the case of China, it's much more mobile because there isn't really a boundary between the rural area and the urban area. And in China, there are currently close to 300 million of rural workers residing in the urban area. And that's huge. And we talk about almost close to 40% of the labor force, of the workforce. And China has benefited from these strong rural workers. There's a technical term in economics, we call it Lewis turning point. Before 2015, there are still a lot of rural workers trying to get a job in the urban area. But after 2015, probably because of the downturn of the economy, or maybe because of the asking price or the working condition in the area is not that attractive, then we have seen that less and less rural workers are willing to work in the urban area. And that's the reality of the labor market. And I see this as a very significant implication, not only for China, but also for the global economy, because as you know, that the Chinese supply chains is part of the global, economy, and that's helped the world in terms of supply of consumer goods and whatever goods you can think of, from factories are actually coming from China. And so this 300 million rural workforce that been currently in a surplus situation, at the same time under a shrinking condition in the longer term, will have a significant implication to world's economy and inflations, and also growth, and many macroeconomics condition will also be relating to the Chinese workforce.
Raymond Yeung there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, January the 23rd. Catch you tomorrow with the latest on Australian business confidence in part 2 of our interview with Raymond, in which he talks about the deflationary risks in China. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.